Serving the underserved and financial inclusion is a topic I'm quite passionate about, as are my colleagues here. So for those of you who might not be familiar with the term financial inclusion, Laurel and Hardy up here, I'm here for comic relief, if nothing else. So if there are folks in the room that are not familiar with the term financial inclusion, or if we need a refresher, what we mean specifically is that adults all over the world, especially low-income populations, have access to and can effectively use a range of services from payment and savings to credit and protection, and that these services are provided responsibly and ethically in an appropriately regulated environment. We believe that financial inclusion can help reduce poverty and inequality by helping people to invest in their futures, even out their consumption, and manage financial risks. When we look at the data around financial inclusion, recent data from World Bank can show that 1 in 4 people on Earth do not have access to any financial services at all. 9 million households in the US alone are unbanked. 31% of all of those households are struggling to get by, right? They're having a hard time to make ends meet. We believe that the financial technology industry, as well as the financial industry at large, has a great opportunity, a responsibility even, to leverage our talents and our resources in developing products and services that reach those that are most in need. And we're going to explore that here today. So with that, we'll get started. I'll do a quick hello to our panel and let them introduce themselves and what they do. Starting with George, we have Marina and Olga here. But George, the stage is yours. Tell us about who you are, what you do, and how and where you're working in this space.
There's not going to be time for anybody else. Thank you for having me. I am George Castaneris. I'm currently the founder and CEO of Lifetime Income Technologies. It's my 8th company. I've sold 4, closed 3. This is the first time I'm doing something in financial services, and the goal is to deliver a free and portable retirement system to replace the current retirement system that exists in the U.S. By way of background, I've worked in corporate America, financial services for 28 years, and I've been an active entrepreneur the entire existence of my life. And an expert in retirement.
I'm Marina Dimova. I'm the Managing Director of Design and Innovation at Women's World Banking. Women's World Banking is the leader in financial inclusion for low-income women around the world. For over 40 years, we have partnered with financial service providers to really help them deeply understand the women customer and design financial solutions that help them achieve prosperity and security for themselves and their families. And in my role, I really focus on both designing innovative solutions for the women customer, but as well as really thinking how to embed behavioral design and human-centered design in the way Women's World Banking does its work.
Hello, my name is Olga Lizarova, and I'm a Senior Behavior Change Analyst at MatBow. At MatBow, in our Behavior Change Department, as Dustin mentioned earlier, we do a lot of work in health, education, and finance. And my work with underserved and low-income population came to happen through Center for Healthcare Experience Design, and the group that we brought together that is currently called Project Do Good. And we started working on, initially through the Center for Healthcare Experience Design, which is also MatBow Center, we started working with children recovering from addiction in suburbs of Massachusetts. And then later we did 2 more projects with my colleagues, some of them are in the room, in Muskegon, Michigan, and North Hartford, Connecticut. So I'm going to talk a little bit about all of those 3 projects.
Great. And folks, too, in the audience, quickly at you, I've got questions for the panel, but so that you're not just watching us talk amongst ourselves, if you have questions, raise your hand. I will call on folks I'll take a break to make sure we're doing okay. But we do encourage an active dialogue. I think that's the best way to do that. Otherwise, we're TV. So with that said, let's kick it off. And let's talk about, for the panel, when we talk about serving the underserved, I've never had this. When we talk about serving the underserved, who are we talking about, and who's being left out that should be included? George?
I'll kick it off. I'll give you 3 data points. Since the early 60s to today, the top 10% versus the top bottom percent of income earners in 1960 was 7 times. Today it's over 13. So that gap has widened significantly. If you use a measure of $100,000 in someone's net value, net worth, globally, 6.56 billion people are below that. 80% of that has less than $100. That's how bad it is. In the United States, it's 250 million people. So one last statistic, just to give you a sense specific to financial services, 64% of the wealth in the United States is managed by 5 companies. And the remaining 20% or so is another 15 companies. So the whole focus on solving for the underserved is super critical to everybody in this room, because if you don't, one of 3 things could happen. Socialism would be a possibility. I mean, Bernie Sanders had a pretty big platform. Austerity programs, or increased taxes, because it's already linearly progressing towards economic catastrophe. That's who the audience is.
Marina?
So, and there's no surprise that in our organization that has women in its title, our focus is on the women customer as an underserved customer. And I have like 3 statistics as well to paint the picture. So globally, we're talking about 1.1 billion women that do not have access to any formal banking account or financial service. And you might ask, well, that's probably the case for men as well. But when you really look at the numbers, there's actually a 9 percentage point gender gap in the financial inclusion across men and women in emerging markets. And not only that there is a big gap in gender parity and how populations are actually engaging with the financial service system, but also as financial inclusion is increasing worldwide, this gap between inclusion for men and women is actually growing. And the final number I want to leave us with is $28 trillion. This is the amount that will be contributed to the global economy if we achieve gender parity for men and women across the financial sector. So a huge opportunity and a widening gap that we think is really important to address.
I'm going to add more numbers. Say, if we decide to look at this from the perspective of economical perspective, statistics and numbers, we know that around 48% of Americans are either poor or low income. We know that around 21% of children are either poor or low income and are about to get on food stamps by the age they're 20, and most of them are African American, so it's also not equally distributed by race. But the way that we like to look at it, and this is based on the work that we have done so far, is by neighborhoods and by communities. Because when we look at those numbers, we can't really tell whether those people are located in the city, in the county, in the state, or like what is the right measure to look at it. When we started looking at the states, we looked at Connecticut, and it looks pretty good. It's one of the richest states in the country. The average salary is super high. It's well off. And then we started to drill down to the level of neighborhoods where we worked in North Hartford. And the average salary there is $12,000. And most of the households are female-led. And they have 2 or 3 children on average. And so the point that I want to make is that there are different levels at which we can look at the data, the statistics, and it's really important for us to understand that the context and the level of the intervention that we want to design would be different. And if we're looking purely at the numbers and don't really consider where those people are located, we might miss the point. And based on those neighborhoods, actually in 2013, Obama created the special designations called promise zones. In US, there are 22 promise zones, and North Hartford is one of them. There are 21 others. What it means is that in those promise zones, there's high level of poverty, there's high level of violent crime, high level of addiction, low employment opportunities, low level of public and private investment, and like all of that creates the broken social fabric that is really hard to fix and extremely hard to address.
Would love to hear a bit more about those determinants. So in my talk, I quickly pointed out that we can think about the different determinants from individual, from social, from environmental levels that cause and hold back low-income populations, right? In health, we have a formal system of social determinants of health. We don't quite have that yet in financial well-being. Would love to hear from your experiences and your perspectives what those different determinants are that both cause and hold back individuals of low income from getting the services that they need.
Okay, we'll keep going in the same fashion. I have a strong opinion on this one, and part of it is I've had the benefit of living on two platforms, the Fortune 100, established institutions, and startup world. I think one of the challenges, and we were actually talking about this as a panel outside, is the sheer mass of balance sheet wealth in big companies is creating an enormous resistance to change the economic model. I don't know who it was earlier today, but they showed the mainframe that still exists in some of these big institutions, or people still looking for COBOL programmers. They are so big that their reluctance to switch gears in financial services and make money differently is super high. And for the first time in our history, with technology being as advanced as it is, you can personalize and scale very, very rapidly and make $5 a person at a time. If you think about financial services, it used to be, how old are you? How sophisticated are you? And how much money do you have? And if you met the criteria, you'd be a customer. So I would argue that one of the biggest challenges that's preventing progress here, specifically, is the economic models of established institutions are slowly being disrupted. And I would argue that Betterment, as an example from Dan, is one of the first ones that started to provoke, you know what, we could do this for less. So it's just the beginning, but that's, to me, one of the big issues. The second one is obvious to everybody, the regulatory environment. I'm always asked if I focus on that, and the answer is no. And it's not because I don't respect it. It's, I know if I think about what's right for the consumer, I'll back into the regulatory environment later. That's just the way I process.
So when we talk about either financial product design or consumer protection, we really need to think about women as customers different than when we think about men. And specifically, that's the case because the context in which low-income women live around the world in many cases is quite different than what is the context for men. So this really changes the way they interact, think about, and use financial products, and really determines the needs they have for products and how they're structured. So I'll give a few examples. First, at the individual level, what we have seen around the world is that there are strong barriers for women to actually even get to opening a financial account. First, really not necessarily having the right identification to even being able to prove who she is so she can open an account. There are things around property and ability to own property that really makes it much harder for you to get credit because you don't have the right collateral to even get to be a credit-worthy individual. And besides that, there is a lot of other cultural barriers that need to be taken into account. I really like an example from Mexico where in research it was shown that women carry out their daily activities within a radius of 20 minutes walking from their home. So if your mobility in a place is 20 minutes walk through your home, think about kind of the social interactions you have, or even the places you can get to and how close a financial branch or an institution needs to be. So it's even in the realm of consideration what you might use on a daily basis. So that's more on the individual level. On the other hand, looking at financial institutions, what we have seen from years and years of experience is a lot of the time when we do partnerships, and we have over almost 50 partners around the world, financial institution partners around the world, often what we see is that they're not even thinking about the woman as a customer. So it's definitely a segment that intuitively people don't think about until we come about and bring that up as an opportunity. And why we think that's very important is that if we don't design with women in mind, they tend to get left behind from the system. And what we have seen is that what we call gender neutral design actually doesn't get gender neutral outcomes. So in order to really make sure women are included in the financial system and they have the products and processes and services they need to fulfill their financial lives, we really need to think about and internalize, understand their context, and remove the barriers that stop them from interacting with the financial system.
I'm just going to add a couple other barriers and insights. I definitely agree with George about the financial models that don't support equitable change, especially for people who we're talking about at this panel. At the level of social barriers, there's definitely this cycles of poverty. So it's generational. It's not something that forms just for this individual. It happens over time. And what showed in many different studies and research was that the economic mobility is very low for people in the low bottom, as it is actually in the upper quintile. So it's actually good if you're in the upper quintile, because most likely you're going to stick there. But it also sucks for people in the lower quintile, because you're also going to be there. And if you don't have education, the probability that you're going to stay there is even higher. The other thing is, when we think about neighborhoods and communities, we don't want to talk about things that determine the way that you're going to be, but people born in those communities, in those neighborhoods, the zip code determines their chances for success in life. Their zip code determines whether they can graduate school or not. The zip code determines whether they're going to have poor health outcomes or not. It does. And at the individual level, as we were working with some of those communities, we actually heard a lot about hope and purpose, and how much does having or not having the sense of hope and purpose determines their future outcomes and opportunities.
So along with hope and purpose and non-fatalistic attitudes, we have a question from the audience that asks about with underserved populations. We know that it can be a challenge to work with them, and there are some unique challenges, as Olga's pointing out. But the question is, how do we best engage, or how do you engage those underserved populations? I'll leave the question there, and we start with Marina.
Mm-hmm. So I think what we've heard until now throughout the day in terms of tools and methodologies of using design and different design tools and techniques, all of these are incredibly powerful tools to engage with underserved populations. And the two things that I would probably point out really strongly is, first, we really need to do the research right, so we really understand from their perspective what are the key challenges that are experiencing either in interacting with financial services or how they're even conceiving and thinking about financial services. What are their biases and misconceptions about how they think about what these products are, what they can provide for them, how they fit in their overall financial goals. So this consumer research component is incredibly important because I think it's really important to start from understanding of what these consumers know and want and build from there. And then this is really important feedback to plug into the design work we do in terms of designing solutions and products to help engage consumers. And I'll probably make a final point around really thinking about the customer experience as they interact with those products. So it's not only about the features and the product and the cost of the product, but how is the product positioned? How are we talking about them? Who is the first person that presents the product to a new customer so they can build the trust and engagement in something that's potentially quite new to them. And my analog is always like my hesitancy in, trying Uber, for example, for the first time, and me trying to get feedback from friends. How is it? Is it good? Should I try it? And then kind of making the jump. And it's the same thing about really trying to build those systems of trust and understanding. So the products are embedded in the day-to-day lives of consumers, and also they can build trust in something that's quite new for them.
Your experiences.
Yeah, so everything that Marina said, also all of you have been here before, so co-design is one of the most effective techniques to engage audience, and truly empathy is essential for the engagement, but it's not sufficient, and we're not going to go far enough with empathy when we're trying to understand the underserved population, because we are not able to get into their shoes. We actually are not able to understand to the full extent of what it is like to live the life that they are living. So the way to go is to invite them to the table and to ask them to co-design with us, to engage them, and then allow them to have this tools and allow them to have this methodologies that we use, because designers should not be the only people designing. We should be inviting people to design with us. We should be allowing people to be creative, to stimulate their creativity, to allow people in the communities to be entrepreneurs, to be co-creators. And I think that everything that's going to help us to follow that path, to invite them, is going to help us to also build a more engaging, efficient, effective solutions that people actually are going to adopt and use long time.
George?
Yeah, two comments. I think the first one is the foundation from my perspective on engagement around financial services is 100% predicated on trust. And people have a tendency to trust friends and family who are not experts in the field versus a financial advisor. I've done enough testing around that to be able to validate it and could share some stories. The other thing around financial services, and maybe some of the folks in the audience recognize this, we have about a 36% divorce rate in the United States. One of the top 5 reasons for divorce is money. It's a very sensitive subject. People do not want to talk about it. It creates tension, anxiety. So the concept that was shared earlier around default and automatic is very powerful. Interestingly enough, that was actually developed by McDonald's in the 401k business. McDonald's had a challenge figuring out how to increase participation without having to give money back to the highly compensated. And it's too expensive to go out and communicate in live meetings at all the McDonald's. They were the first ones over 10 years ago to institute negative enrollment, and there was a huge outcry. Just to give you a sense, they considered it to be unconstitutional. You're taking people's rights away to make a decision. Now, that courage from one company has been adopted by close to 90% of the plans, and it's become the social norm. But when it first came out, big issue, especially for employers, because if I have automatic enrollment and I give a match, my contribution goes up. So it's very possible, but my position would be you have to establish trust, which is very difficult, but the more you can do for them and inform them about progress, the better.
Question in the back.
It's hard to hear. Hold on.
We got a mic coming. I can do that.
Yeah. My context is from India. We have a lot of banks giving out loans to the individuals there. One of the case, I was talking to one of the colleague here, is the loan has been given to the individual and he was unable to pay that. Back enforced that guy to pay that, but then he was not able to do that. And the bank did the other way, like sending the goons to the guys and to collect that amount, but then they couldn't. Unfortunately, that guy has to go he suicided himself. The bank had to pay about more money than what they actually were. He was supposed to pay. So in this context, I mean, how are we creating solutions for those kind of stories where we make them feel comfortable, say that, okay, it's a bank which is going to take care of you. What's the solution around that?
I'll give it a shot and then give you guys some time to think, because it's not an easy answer. What I can share, partly because I grew up in the insurance industry, so grew up kind of managing risk. Micro lending, where you can diversify the pattern of risk, and you limit how much you lend people, $500, $200. There's one company from one of the founders of PayPal that does that with a company called Affirm. And they can socially profile you, and it's starting to happen in different parts of the world where you're going to start receiving a personal rating that's pretty public about your social being, your economic being, in every aspect. I think what's happening, though, in a situation like the one that you described, the underwriting history doesn't exist on microloans, so unfortunately, it's difficult. And I've already seen companies go belly up that are doing it that really suffer because they're not sure exactly how to underwrite it and validate. I can give you a loan without charging you 25%, for that $200 or $300. So I don't have a perfect answer, but I know it's being addressed now differently than ever before.
So I'll start historically, kind of through the evolution of microcredit that started as a group loan offering, where a group of people will take individual loans together, and the loan was kind of underwritten to the group. So if an individual was not paying, the group was responsible to pay up the amount that the individual didn't pay up. So in that social setting, there was a really strong pressure to live up to the expectation of a group and pay up the loan, and that really led to the huge explosion of the microcredit and microfinance industry. This has kind of evolved over time, and we're really looking at a transition, especially in India, with organizations like Ujjivan and Jana Lakshmi that are moving away from the group lending model to an individual model where the key component is how do we underwrite the risk? How do we understand the risk that we can take up and what actually the micro entrepreneur can absorb as risk? So probably about 5, 6, 7 years ago, the transition was really, really expensive because it actually meant a lot of loan officers being on the ground, talking to the consumer, really understanding their business, going to their home and just really by paper assessing the assets of the family and the enterprise. this really doesn't allow for scale. So what the trend has been over time in the past few years is really using social data like your payment history on your cell phone or other publicly available data that allows you to understand more about the customer, gives you more confidence in what type of money they're able to absorb, so you can more quickly and cost effectively extend credit to individuals. But we're still learning and developing solutions around that.
Just one little bit to add to all of that was said already. There is the bank in Bangladesh that I was reading about recently called Kadeem Bank. That is an interesting model, I think, to look at because they have incredibly high rate of paying back the loans that they are being provided, almost 96%, 99% in the United States. And there are a lot of things that they do differently. Actually, they do everything differently. If you look at the traditional banking system, they looked at it and they decided to do everything the opposite. So if in the traditional banking system, people are asked for the collateral, like anything that's going to prove your credit worthiness, that's exactly the opposite. They don't ask for anything. If in the traditional banking systems, people who are offering the loans are people like investment bank, people who have money in this system, in the Kadeem Bank, people who are on the board members of directors of this bank are poor women who are managing it and deciding what are the rules and under which conditions the loans would be given. So I would recommend you to look into that model and see what they are doing to address that problem.
Over the wire, a question for George came in. That question is, George, for customers with balance sheet wealth, can you get them to change? And if so, how?
I'm not sure I fully appreciate or understand the question, because when I made the comment around the balance sheet, that's more institutions than individuals. And if it's an individual, then the question would be, what do they need to change since they're largely already well off? So is the question, how do you get established institutions to change their behavior based on the economic model? Or I just need a little help? Oh, thank you. I found you. And now, just if you guys don't notice, I think Dustin invited a fly as part of the panel because it keeps going between all of us. I actually studied that quite a bit. I did a lot of research understanding the operating velocity of an established company versus a startup. And when people ask me, where's the magic? I say it's in the middle. Large companies have the capability and the appetite, the balance sheet for risk, but they won't take it, especially if they're publicly traded, right? And the incentives at the highest level of the organizations aren't such that you really want to rock the boat. And the balance sheets are so large that if you stopped operating and you just kind of kept your nose clean, you'll be here for some time. Yet you have the startup environment, and I remember when Betterment first started as an example, or Acorns, or pick a company. And they're quickly dismissed because it's not necessarily the way they're used to operating. So the middle is if you took the balance sheet of a startup and you took the balance sheet of an established company, they have complete complementary assets and liabilities that if you were to match them, it would just be a wonderful place. Culturally, nightmare. Absolute nightmare. So my recommendation, which actually this started in Singapore and it's actually in Germany today. I think it's called FinLeap. I apologize. I don't think I have the name correct. But there's companies that will build companies for established institutions. So an idea for an established institution to protect yourself from being challenged is pay somebody to build something after they understand what your assets are, take a minority interest, so it's nothing more than an investment. You have no headline risk, and if it demonstrates success, and success is driven largely by having enough capital, more times than not, then you pull the trigger when you're willing to take a majority stake, and you keep yourself protected the entire time. The first thing to go when the market crashes, think of how many financial services institutions have an innovation lab or strategic capital deployment. I've lived all of them. I know most of them. 2008 hits again. that's the first thing to get cut because it's an expense and it takes time. So my recommendation is to look at a build for companies model versus I don't know, what I've been witnessing lately. I don't know if that helps. Call me.
So, did you have a question?
Quite often, it's very difficult for a private company to, if you're going to do anything stably and profitably in this market, you need to get to incredible scale extremely quickly. It's possible. A surprising number of people have smartphones that are in this demographic. Really surprisingly high proportion. So they can get apps, they can do stuff, but the actual banking system stuff. How do you bootstrap a service or product when most of them don't trust any of us, but they trust a family member, and do it in a way like, can you get an underwriter from a government to say like, do it and we'll front you, I don't know, when the market crashes. But like there's not yet, even with technology, a way to serve them in a robust way to make it worthwhile.
This is a book I don't know if that was coming to me. I apologize. You looked at me, so I felt like we were having a conversation. Anybody?
I can start.
Yeah, please.
So I'll bring an example from a market we have worked in Nigeria where the financial system was really interested in going downstream, and we're talking about the fourth biggest commercial bank that really saw an opportunity where digital money was coming in. Better regulation for working with digital platforms was opening up, and they knew that if they want to grow, they cannot continue working with the established kind of upper middle income class that they were currently serving. So at that time, they were really interested and there was appetite to go down market, but there was not enough of an appetite to kind of explore the risk on their own. So we're talking about a partnership with Diamond Bank that we set up, and currently they're rolling out their 7th product for lower income populations, but the very first one they did was philanthropically funded. So we're talking about, in a way, the government, this was like foreign aid agency stepping in and saying, and it was really a small amount. We're not talking more than, I think, $300K US dollars. So it was a very small investment that allowed to tip the boat to even try. And from there, we stepped in to build on the designs, roll out one product, and it really kind of snowballed from there. And at this point, they're really serving a very large market with lots of products. But it really was that initial step that was risky and hard. And it wasn't the money in a way. And this is parallel to an earlier conversation. It's not about how much you save. And from the consumer point of view, it wasn't about the money and how much it was to invest, but just really having somebody to kind of ease into this market so you can start making your own investment and build a little bit of a confidence that, you know what, we can do this.
I'll just add, but from the perspective of working with communities, that I'm even going to question if we need to scale that, if we need to continue working locally and just replicate the models at the local level in all those different communities as they would fit or not fit, and repurpose some of the parts and modules that worked, versus trying to create the huge vertical structure that's going to try to just go from the small intervention that we created to this large global intervention that's going to cover all the different markets. So, and the example would be when we worked with communities, we know that they trust their leaders, they trust the influencers in the community, they have their local heroes that they want to listen to, they have their local groups that, like church, some other non-religious chapters, someone who's taking care of agriculture, someone who's taking care of their children. So it's very local, And there are some insights that, like similar to behavioral economics, that you'll able to digest and say, what if we try to apply this in a different context? So that I think would hold true if you would try and test it and try to see, would engagement with this local leader lead to engagement with this larger group? Could we create the community engagement through this person and then create the intervention from there? Versus trying to create an organization that's going to try to engage with multiple different cities, countries, or if that makes sense. Yeah.
Last question for each of the panelists. Capitalizing on Olga's comments around hope and optimism, 30-second parting salvo for what we can be hopeful and optimistic about as the role of design and technology in serving the underserved populations and markets. George?
I think Olga actually said it, maybe indirectly. With that Bangladesh bank, really focus on doing the absolute opposite of the way things work today. And when you ask the question about established institutions, if I had to leave everybody with one word, you have to have the courage to be able to take those bets. There's ways to do it to protect yourself. And this is everyone's problem. I give speeches regularly on the velocity, operating velocity and change. And you look at how much is going to be automated, and this happens all the time. People will look at their watch and try to figure out if they personally have to worry about it. This is going to hit everybody. We're talking about finance. Healthcare is a big issue too. Those two alone represent enormous economic challenges. So I would just leave you with, have the courage to break the mold. And that's what could help you scale. Dan?
I'll focus on technology. And again, Dan made a point earlier that smartphones are becoming ubiquitous. And that is the case even in emerging markets. But where the revolution still is actually in dumb technology. So we're talking about feature phones and dumb phones that are really what is in everyone's hand. And because of connectivity and battery life is where we really can meet the customer, because these are the phones they're going to use for a long time, and we would like to challenge ourselves to offer financial services on those devices. And there has been incredible progress in multiple markets across that. And I'll leave that with, it is a technology revolution. It allows us to reach customers so much more effectively, and it doesn't need to be rocket science. So it could be a technology solution, but finally, let's not put all our trust in technology and really focus on the combination between technology and designing the user experience that goes along with that technology. And I believe firmly that will really take us a long way.
I'm going to focus on human-centered design part, and I'll challenge you all to think about the kinds of problems that those people might have. So it's not just the number, it's not just the number that you're going to see that they have or they don't have annually. It's not the debt on their credit card or mortgage. It's the other things in their life holistically that happen. Have they been evicted recently? Have someone in their family been incarcerated? Do they have someone to take care of? Social things, psychological things. So think about everything that might happen in their life and affect the way that they think, the things that they feel, and the decisions that they're making. And if you would be able to answer answer to this challenge and say, how might we create the financial services that work for those personas, I think that you will succeed.
We are out of time. I'd like to thank my esteemed panel. Please reach out to these folks if you are interested in serving the underserved and financial inclusion. They are a wealth of knowledge. Thank you all, and thank you, George, Marina, and Olga.